It's time for the Phil Ferguson Show.
Buongiorno tutti. Hello, everybody. This is Phil Ferguson, and welcome to the show. This is the cleverly titled The Phil Ferguson Show. We have a lot of stuff coming up in today's episode. I am going to have a segment on some mail that I received, some email. Thank you for that. One of the topics will be ESG, which we've discussed before, and I get a lot of pushback on it, so I'm re-explaining myself and covering it again in case you have missed it. And ESG is environmental, social, and governance. And since I have a whole segment on my thoughts, I'm going to leave those thoughts for that segment. You'll hear that. And I also do talk a little bit about the value or the lack of value in investing in commodities and some of the logic and the reasons why I don't do that. And then later in the show, I have a segment on a modification of the Polaris Plan. And as I say in that coming segment, and I'll say it here, if you don't know the Polaris Plan kind of sort of well, it might not make some sense in parts. I think it'd probably be okay. But if you want to go back and review the Polaris Plan as it was laid out several months ago, it would help you have that framework to understand the changes that I have made. And I made those changes, decided to start making those changes in November, but I thought it was appropriate to apply that change to virtually all of my clients before I give it away free here on the show. So that's why there's been the delay of having it in the show. And again, of course, we'll have that all explained in the segment, so I'm not going to do that now. What I'm going to do now is just share a little personal stuff, my ongoing pool obsession, pool water temperature obsession, because I was really hoping I could use the pool all year round. So for those that haven't been keeping up, I do have a rooftop water heating solar panel system. They're not like photovoltaic panels, but I don't know, water solar panels that heat up the water. And of course, when it gets really cold, below 40, even below 50, and the sun is really low, winter solstice, the solar panels on the roof are not enough to keep up with the system. So I had one of the local pool companies come in and talk to me about heat pumps, and they, salespeople, I get it, right? You want the big commission. So they were recommending that I spend $6,000 to $7,000 on a heat pump to allow me to more easily use the pool in the winter. And so I think without doing anything extra special, I would, from the middle of December, maybe even towards the winter solstice, because the ground was warmer from the summer and the fall. So from middle December to middle of February, that's 2 months, the pool really wouldn't be comfortable to swim in at a temperature that I would like, even with the solar water panels on the roof and the idea I had of putting 2 pool blankets on, because with the one pool blanket in the middle of the winter, overnight, first thing in the morning, the pool temperature would be 74, and then it'd be 78 late in the afternoon. 78 is doable. If you're 18 or you're doing hardcore laps and you're really into swimming, you'd probably be perfectly fine and you could use the pool. I wasn't real happy with 78, even 80 is a little chilly. 82 is starting to get pretty good. 85, 86 I like. Warmer than that, you run the risk of it being beautifully warm and wonderful to walk in, but if you start doing physical activity, for me, it might then get too hot. But so I wanted just to add a little something else, a little something that could give me a couple of degrees. And their suggestions were, like I said, give or take $6,000. And of course, with the $6,000 heat pump installed, all I'd have to do is turn that bad boy on or set it up to automatically go. And within a few hours, the pool would be at whatever temperature I'd like it to be. The bigger the heat pump, the faster this can happen. And so that's all very cool, but I didn't want to spend $6,000. I'm sure you can appreciate that. So my question then, and everyone I asked said it can't work, it won't work the way I think it does. I bought a very, very small heat pump. So heat pumps often have a rating on them on how many BTUs, British thermal units, which is the amount of one British thermal unit can heat 1 gallon of water by 1 degree in 1 hour. I think I have that, but you get the idea. And they were suggesting 75 to 135 to 150,000 BTUs. The machine I bought is 12,000. So not 100,000, 12,000. And as you might imagine, the amount of heat it can add to water is dramatically lower. I get that. But my idea was that I'm just going to leave the temperature of the pool at a constant temperature, or try to, something in the low 80s to the mid 80s to even the upper 80s over the winter. Can I add 1 to 1.5 degrees in a day? We're talking 8 to 12 hours this machine would run. And if the pool is too cold, I cannot turn on this machine and have the pool be warmer in an hour or two. It's just way too freaking small for that. So this $700 heat pump has now been running in the pool for several days. And yesterday we had 86 degree pool, 87 degrees. And I'm optimistic today, once the clouds go away and the sun gets high in the sky this afternoon, I'm expecting 88 to 90 degrees. Again, most of that's coming from the sun, but this heat pump is adding 1 to 1.5 degrees to the water per day. And eventually, it adds so much heat that then the pool's hot and it evaporates faster. So there's only so far. I can't get it to 212 degrees over 200 days. It won't work that way. But I only want to add 3, 4, 5 degrees, and it can take a week to add those degrees as long as I can then keep them with the 2 pool covers on. So like I said, today, after lunch, a couple hours after lunch, I expect to go swimming in an 88 to a 90 degree pool in the first week or two of February. So I am now optimistic I have enough stuff to make the pool a temperature that I want on a regular ongoing basis, so that any day I could go pull off the 2 plastic pool covers, pool insulators, and hop into the pool. Of course, it's interesting. People are like, oh my God, how much time does it take you to take off those covers and put them back on? It's not that long. By myself, it might be 10 minutes, maybe, if a helper. Both of them can come off in 2 or 3 minutes. So it's not that hard. And that's part of the fun, part of the physical activity. The reason I have the pool is to enjoy it and play in it, but to do some laps and work out. So if there's some physical work involved with me removing and putting back on the pool cover, it's just me being active a little longer. So I don't even see that as a problem. But anyway, that's probably not what you wanted to hear for the whole show. The other thing, of course, yesterday, spent the day at Epcot, and I was so excited because when we went to the region that is Italy, it is now filled with Italians, actual Italians, probably coming over for less pay than they should get, but having the experience of working in the United States for a year and getting to visit the United States and practicing their English. And matter of fact, everyone I spoke to, when they did speak in English, they were pretty good, because most of the customers are English, so I'm sure they screen for that. But I got to talk to 7 people, only a couple of minutes each, because they're at a job. And it's so nice that I can visit and talk to them, but I have to be respectful for their time and not get them in trouble when the boss comes around the corner and says, have you been talking to that guy for 10 minutes? Go sell something. So, but that was great fun. 7 different people. So I had great fun. So we'll take a quick break and we'll come back and we'll have our segment on ESG and commodities. And then a little later on, the Polaris Plan update, the 2023 update. And sometimes I'll go 2 or 3 years without making a change. Sometimes it's more frequent. And this is the one that we're doing, that I'm announcing here in February of 2023. If you hear this somewhere in the future, it might be helpful and give you ideas, but it might not be what I think you should do at that point in the future. But it helps you think about how the process works. So don't go anywhere. We'll be right back.
You're listening to The Phil Ferguson Show.
My father, the man responsible for my education, taught me that Islam, rightly understood, is a religion and philosophy of peace. In fact, he said that for any society to be peaceful and prosperous, it had to institute the rule of God, or Sharia. I came to disagree with my father. It was a gradual process that started when I entered and lived in societies such as the Netherlands and the United States that applied man-made constitutions and laws. Both countries are peaceful and prosperous. I now disagree even more with my father that Islam is a religion of peace. When I look at the amount of security that is deployed tonight here, the amount of security that is deployed for the Richmond Marathon. 6 months ago, the Boston Marathon was bombed by 2 brothers who invoked the founding documents and the founding father of Islam. I disagree with my father when I look at the wanton killing of the Westgate Mall in Nairobi by Somali men invoking Allah and Muhammad to justify their horrid act. Kenya is the most hospitable country to Somalis fleeing their own country, so it distresses me even more. I disagree with my father when I look at the reports this week of 30 men and women worshipping in Iraq who are killed by a suicide bomber invoking the very same God and the very same prophet that they invoke. I disagree with my father when he says that Islam is a religion of peace. When I look at the 120,000 dead in Syria, Syria is now a stage of a proxy war between Islam's 2 most important and most influential nations, the Sunni Kingdom of Saudi Arabia and the Shia Islamic Republic of Iran. I disagree with my father that Islam is a religion of peace when I read about the almost daily reports of the destruction of churches, the pillaging of Christian property, the rape of Christian women, the terrible exodus of Christians and other religious minorities from Muslim countries. All this is done by men who invoke the founding father and founding documents of Islam. I disagree with my dear beloved father when I read about the teenage girl in Pakistan who's shot point blank in the head by a man invoking Allah and Muhammad because she wanted education. In the name of Allah and Muhammad, women are forbidden to drive. They're forbidden to own their own reproductive rights. They're forbidden to do anything unless they have permission from a male guardian. I disagree with my father that Islam is a religion of peace when I read these founding documents and I study the history and the example of the Prophet Muhammad. In there, I find an insistence of war and intolerance towards infidels, the hypocrites, those who associate God with others, homosexuals, women, and so on.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation And you, of course, should consult with your financial advisor or tax professional before taking any actions. I'm going to do a little bit of mailbag here and respond to a couple of emails and a YouTube comment. And of course, those people will see the responses to them. And I'm going to kind of summarize a couple of these ideas in this little segment. And part of it sometimes is confusion. And I can only assume that I've done something or said something in a way that wasn't clear. So I own the responsibility of being clear, and sometimes I'm not. So we're just going to go over a couple of these things. The first one is a YouTube comment, and the person will know who they are if they listen to this episode, and that's fine, not a problem. But I'm going to boil down their comment to the idea that either you invest in any and all stocks because you're not really doing any good from the perspective of democracy, the environment, church and state, blah, 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 or you don't bother investing because otherwise it's not worth the effort. I think that misses the mark pretty good. Hopefully I didn't say anything really close to that. I'm guessing this has to do with comments that I may have said in episode 424 in a segment I did on ESG fun, environment, social, and governance. I've also had other people, some nicely and some not so nicely, tell me that I have a moral obligation to the planet to invest and choose and support companies that do the things that I am in favor of and not support the companies that don't do the things that I'm in favor of. Yeah, I think that's all right. And there's some merit to this as a concept, but the real couple big problems. One, every ESG fund is different. And so you have to find one that does what you think it should be doing. Two, any fund that does ESG investing can change their rules. Three, they all have a clause in the contract or disclosure documents that say they can ignore their own rules and invest in something if they think it's going to make money. So you're probably not getting what you want. If you're getting what you want, it's not going to stay what you want, and they reserve the right to do whatever the fuck they want. So for me, an ESG fund is a marketing gimmick. Now, let's pretend for a moment that you found a fund that does what you want it to do. It doesn't vary from that. It doesn't change. It doesn't take buying opportunities to make money or bet on stocks that you don't like. And it sticks to truly what you want to do. The first thing, of course, is that this investment is probably going to have a much higher expense ratio. A lot of overhead, research, efforts to doing what you want to do. It basically becomes a managed fund like all other managed funds. And I think the data is really clear that index funds provide a far superior performance than managed funds. If someone could show me a reason or a way that ESG funds would do better than the market, I would be willing to consider it. But even if it does better today, it doesn't mean that it will do better tomorrow. So I don't want to pay those extra costs. So I want costs to be really low. I want to invest real efficiently and have kind of a higher return, a better return, because the expenses aren't eating away at my money. Now, the next real big problem, and people have a really hard time with this, and I don't know if the person who made this comment fell into this category, but I'm just going to address it anyway. The idea that you do or do not buy a stock individually as a person, it doesn't fucking matter. And I mean, it's going to matter to you because you're going to make or not make money based on what you are investing in. But let's say an oil company, if you are refusing to buy the shares of the oil company doesn't care. It's like shingles. Shingles doesn't care. The oil company doesn't care whether you buy the stock or not buy the stock. There's exceptions, and I'll cover maybe a couple of those here. But when you buy a stock or don't buy a stock, generally speaking, with the exception of a few key moments in time, like a initial stock offering, you're not buying or selling the stock from or to the company. you're buying the stock from another person that already owns the shares. And so if you decrease demand for that stock by getting a whole bunch of people like you that think Exxon might be bad and you all avoid Exxon, there is a theoretical possibility that you could drive the price down by changing the supply and demand, which is often reflected in the price of that stock. So there is merit that you can do that. But on a small scale, the company keeps running and doing what it's doing. It doesn't care if the stock is $92 or $85 a share. Again, there's always exceptions to that, which people would have a good point to make as a counterpoint to what I'm saying. However, if the stock is really worth $95 a share, but it's now selling for $88 a share because you have decreased demand, that lower price will in and of itself create new demand, because there are going to be people that don't give a flying fuck about your agenda, and they're going to look at the stock and say, oh, it's $88 when it's worth $95, and they're going to buy it. And so the end result is you make less money. You didn't do anything productive at all. You just made yourself feel good, and you provided an opportunity for someone who has, well, at least does not hold your agenda. You've helped them make more money. So you, in a way, again, according to me, you have helped someone who doesn't share your values make money while you've cost yourself money. So I think this whole thing is a debacle from beginning to end. So my alternative of, well, Phil, what do I do? How can I help? One suggestion that I have made is that you invest for the sake of investing and make what you can make. And then as you're making money, you can skim 2% off every year and donate it to charities that are actually doing what you want to be done in the world, whatever that is. And people will often say, well, there's no way I'm taking 2% of my money off every year. Well, when you're paying a really high expense ratio on a fund that's doing ESG investing, that's exactly what you're doing. You're losing 1, 2, 3, 4% a year from the combination of expenses, higher taxes, or underperformance. You are making less money, and as I said earlier, probably doing nothing beneficial. So in this case, make what you can make. If you really want to help and do something good with your money, skim 2% off and donate it to charities or causes that you actually support. Well, I don't know if you heard, but in the background, our cat was tripping balls because we were getting a little rain and thunder. So I had to go calm down the cat, which is perfectly fine. They often calm us. It was my turn to calm the cat, but I'm back, and I think the thunder and rain has passed. You may have heard that in the earlier part. Now I'm going to go with another email. Someone asked about buying precious metals, and they're buying coins and ingots and bars and stuff of different metals, and what I think of that. I don't know when I last covered this in specific, so I can't give you a show number to look back to, but I'll share a few thoughts with you here. And I'm looking at a website called Long-Term Trends, Stocks versus Gold and Silver. And it looks at the Dow and the S&P 500 and then gold and silver, of course. In the really, really long term, 100 years or more, the price of gold, the price of almost all precious metals, some do better than others, but they make about inflation, or they return or they increase in value about the same rate as inflation, which leads to this famous marketing phrase, which I think is one of the best marketing phrases, marketing gimmicks ever created. Gold is a hedge against inflation. So if the long-term trend of inflation is 3% in your local currency, and in this case, US dollar, gold is going to go up, give or take 3%, maybe a little bit better. In some short-term time periods, and this is me, and I'm very different with what short-term is, a year or 3 or 5, gold can do wickedly wonderful or wickedly bad. So as an example, I'm going to pick the 30-year time period, and after 30 years ending October of 2022, gold is up 392%. 392%. And you might think, well, Phil, that's a lot of money in 30 years. You're right. It is. The S&P 500 is up 782%. And so 391% or almost 800%. You would have a whole lot more money. And that's 30-year time period. 10-year time period? Let's see. The last 10 years, gold average annual return for the last 10 years. No, this is not the average. This is the net return. Is minus 4%. Silver minus 39%. And the S&P 500 up 171% in 10 years. And of course, if you look at 100 years, it's embarrassing for precious metals versus stocks. And part of the reason for this is gold and all precious metals and all commodities, they're things. They just sit there. You may use them to make money with, but in and of itself, it doesn't make any money. This is also true of virtually all cryptocurrencies. I'm allowing myself the opportunity that there's one I don't understand or know about. But companies make money. They create value. So you have inputs that go into a company, and then on the other side, there's a product or products or services that have a greater value than the inputs that were put in. They create value. That's why stocks can have historical returns when you include the dividends of 9, 10, 11% in the really, really long run. And by the way, I think these charts probably don't include dividends. So if that's the case, then stocks do way, way, way better than gold, because gold, silver, all commodities, they don't have dividends. There would be no dividend to pay because it, like I said, it just sits there. So people will often ask me, and like I said, I have an email about this, why don't I use those? Because I have no idea if any particular metal or any particular commodity is going to be worth more or less in the future. I have no idea. If I look at 100 plus years of history, the history says that these commodities will go up with inflation and maybe a skosh more. If a particular item becomes limited in supply, its price may spike. I can't talk English, may spike. But if a new reserve is found, or people tend away from pork bellies and decide they don't want bacon, the prices can fall dramatically. It's a supply and demand thing. It's not what the underlying asset is worth. The question is, will people pay you more for it in the future than you paid for it today? One of the other really big problems with any kind of commodity investing is the expenses. Often you can buy, like the person who sent me an email, they're buying physical pieces of gold. Well, that's cool. You got to buy it from somebody. And that somebody wants to make a profit. So they're selling it to you for more than they would buy it from you. If you want to try this fun little experiment, buy a gold coin at a gold coin shop, whatever. I don't know. Coin collectors are us. Buy a gold coin, pay whatever they're asking, and then for laughs, turn around and sell the coin to them. And I promise you, and if you do this and it doesn't work like this, let me know. But if you buy a gold coin, let's say you pay $400 for a coin, and you turn around and want to sell it, they might offer you $300 because they want to buy it from you. They have to hold it, store it, secure it, protect it. It may be weeks, days, months, or even years before they can sell it back to another person for $400. So they can't give you the $400 back. They wouldn't be in business. They wouldn't be able to have a store. They wouldn't be able to pay their wages and the security. So physical metals and physical things like pork bellies or cattle, somebody has to hold it somewhere and keep it, especially if it's a food product, have to keep it safe, keep it alive, or keep it from infestation or rot if it's like corn or wheat. And these things are expensive. Another way one can invest in commodities, instead of holding it directly, you do fancy fancy schmancy investing, where you're doing puts, calls, options, and all this stuff. And that induces a lot of cost. And so if you look at the price point, the return of metals over time, even with the metals index, you're probably not going to make that much money because it's expensive. So you could also buy sometimes stocks in companies that work in commodities, like a coal mine or an oil rig, coal mine, lithium mine, whatever it is. And now here you are going back to basically being in stocks where a company is taking raw materials, processing them, bringing them out of the ground, bringing them to market, and they are able to sell it for more than what it costs them to find it or refine it. So to me, you're kind of back to investing in stocks. And if you want those companies, well, when you buy the index, you're going to get those companies anyway. If you want to buy those companies specifically and overweight in that category, you could do that, but now you're back into the realm of stock picking in my mind. So I'm not a big fan of commodities for these reasons. Another one is that in the short term, they can be very, very volatile. So if you actually want to make money with them, you have to know when to buy and when to sell. Again, back in the market timing. How one does that is beyond me. And maybe some people have figured it out more often than they're wrong, and they can make money in commodities. Good for them. It's not something I know how to do. I'm willing to bet for like 99% or more of you, that's not something you're going to know how to do. So the problem is really low long-term returns, 20, 30, 50, 100 years. No reason to expect that to change in the next 10, 20, 30 years. Really low returns and really high volatility. I'm willing to put up with the high volatility in stocks because of the high returns. But if you want something with low returns, why not get something with lower volatility? Some people are very upset now that bonds might be down 5, 10, 15, or 30% if you have long-term bonds, which hopefully you don't because you listened to my advice over the last couple of years. But you can now make 5% in short-term, really conservative bonds. Now, if rates go up more, you might make less than 5 or even slightly negative, but you're not going to have where the price of gold goes down 50 or 60% and it takes you a decade to break to even. So I just don't see a reason to buy it. I don't see a reason to include it in my portfolio. The only argument that you could make is from a diversification standpoint that if 5 or 10% of your money is in commodities, specifically not in stocks of commodity companies, you could sell it when it jumps up and you could buy more of it when it falls down. But I'm still not convinced that that works. And of course, holding these things is going to be very expensive, and doing futures and options and puts and calls is expensive. So I don't use it. I've not found a way to convince myself that it's actually a good thing to hold. So that's some thoughts on metals, commodities, and stuff like that. Plus, of course, the earlier thoughts. I'm just going to wrap up this little section. Hope that helped. If you get questions about anything, email me, phil@polarisfinancialplanning.com.
This book, this is the first edition of The Origin of Species. And what is marvelous about it is that anybody can read any page and it makes absolute sense. It's not full of jargon, it's full of argument and observation. And that's another reason why I admire him so much. There is grandeur in this view of life, with its several powers having been originally breathed into a few forms or into one. And that, whilst this planet has gone cycling on according to the fixed law of gravity, from so simple a beginning, endless forms, most beautiful and most wonderful, have been and are being evolved.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions.
You're listening to The Phil Ferguson Show.
It is finally time. I finally have some time set aside, and I have updated all of my clients with a few exceptions for different reasons, and they probably already know why because we've talked about this. But I have updated the Polaris Plan, revised the Polaris Plan, and this segment is the long-awaited, and thank you for everyone who keeps sending me emails and messages saying when. Now is when. February of 2023, I'm going to give you what I decided to change back in, I think, early November. It's just taken me a good 2.5 to 3 months to roll this out to all clients. And while I do give everything here for free, there is stuff that I know or stuff that I do that I think the people who are paying me should get to enjoy first. So there is that. I am also going to go forward assuming that you're pretty up to speed on what I do, how I do it, why I do it, as laid out in the Polaris Plan. If you don't know what the fuck I'm talking about, that's fine. You can go back to shows from July and August of 2022, starting with show 425. There are a total of 6 parts. Polaris Plan Part 1 through 6, of course, over 6 segments, over 6 different episodes. I'm guessing, without having looked, that each part is 25 to 30 minutes long, so you could listen to all 6 parts in 3 hours, 2.5 hours, 3 hours. So I'm assuming you've listened to that or heard that, or you've listened to the show enough to get the basic ideas, because I'm going to tell you about the parts that I changed, but I'm not going to go through the whole plan. So if you're a new listener, some of this might not click as well as it will for regular listeners or anyone who's listened to those 6 parts. Okay, so at this time, the changes. First, a couple things that haven't changed. The cushion and its size relative to your portfolio and the amount of time you have until retirement has not changed. Again, go back to July of 2022 to listen to that. So no changes in the fixed portion, the bond portion, the cushion portion. All those regular standard rules that I'm currently following are still in place. So that's easy. That's really easy. Now, on top level scale, there's a couple of things that I'm changing. One is that I am further increasing the amount of stocks, the amount of equities that are international versus domestic. Way back, 2005, maybe, I would have 35% international. And it, was around that frame until 2008 hit. And of course, people may know that in the year 2008, the stock market during the calendar year was down 37%. If you want to pick the highest high and the lowest low, which is just random and arbitrary, you can make it look like the market went down, because it did, 50%, give or take. But I like using calendar years because it removes us from the temptation to cherry pick better or worse starting and ending dates just to sell a narrative that we may have. So just for the calendar year 2008, the market went down 37%. That was a pretty big deal. And at that time, I went to under 10% international. I was not particularly pessimistic on international, but what I was, especially after the financial crisis seemed like it was going to be solved, I thought there was an oversell in U.S.-based domestic stocks. And so I wanted more of the money there because I had a higher confidence of future success in domestic than I had of international. And that might have been just purely because of my ignorance of how international works. I'm more familiar, more aware, more attuned to domestic stock performance than international stock performance. Well, basically since then, the U.S. stock market has returned 10, 11, 12%, while international has been 5 or 6 or 8%, depending on exactly when you look at it. But each year, international underperforms, and the more dramatic the underperformance, the more interesting I find it. I want to put slightly more and more money into international. So it was from a low of 10% or less back in 2009 up to close to 30%. And when I went through all the clients, I was pushing them from 30% towards 35. Now, someone might have been at 32 and I went to 33. Someone might have been at 28 and I went to 30 because I'm trying to get to the plan. The plan is, I don't know, the ideal or the draft, but different people have different goals and needs and desires. So right now, for the stock part, after you take out all of the cushion part, and now you have only the stock part left, I'm 30% plus, 30 to 35% in international stock. You might have 22 or 28, you might have 31. If you have 40% international, well, maybe you need to reduce that. And again, all of this is just ideas, and none of this is personalized investment advice, and past performance is not a good indicator of what will happen in the future. It could be totally randomly different. But I'm slightly more optimistic on international, and part of that is because recently the strengthening of the US dollar has helped to lead to the perception that international stocks have underperformed. And for many years they have, but recently, the last couple of years, they've not really underperformed if you take into account how the US dollar has gotten stronger over the last several years. So the question is, will international stock do better than it's been doing recently? Or will it just do better than the US? And or will it do the same? And if the US dollar weakens by, let's say, 10%, you could make 10% more in your international holdings that are held in US dollars, like Vanguard international funds do, like almost all international funds do. And because the dollar has gotten so strong, I think that the risk of the dollar getting stronger and hurting your international investments is low, and that there's a possibility this year, 3 years from now, 5 years from now, or maybe over the next 5 years, that the US dollar could return or approach something more historically normal as far as its strength, and that would assist the apparent gains, the real gains that you've made in US dollars. So again, this is for people that invest in US dollars in the United States. If you're in another country, this might be backwards. So keep that in mind. As far as what to hold internationally, oh, and by the way, all of these adjustments really require a portfolio that's $200,000 or more to be meaningful. I mean, if you have $40,000 or $50,000, you can't own all these funds at the same time because almost all of them have a $3,000 minimum. So you can't. You literally can't buy enough funds from Vanguard to be able to do this. And even if you can, you might be doing more work than it's worth. Also, for going forward in this segment, I'm going to assume that you have significant money in an IRA, Roth IRA, or some other tax privileged, qualified for special tax treatment, qualified accounts that you can do these adjustments in without having a big tax bill. For some investors, and this is why some of even my clients didn't get fully adjusted to the plan in 2022, and maybe we'll readdress it in 2023, is because if you have a large portfolio, that's freaking awesome. But the things that we've been in have done not necessarily that well in 22, although some things did quite well compared to everything else. But if you've owned those things for 5 or 6 or 7 years, you might have long-term capital gains taxes to contemplate. Often it's not that big of a deal, but for some people, for some reasons, it can be a deal breaker. So you have to ponder that. All right. International, I now have in 6 different funds. It is all from Vanguard. International Growth, International Value, the Pacific Fund, the European Fund, Total International Small Cap, and then Emerging Markets. These are not as granular as the U.S. portion, which I'll go over after the international portion. And there's some moderate overlap, but there are opportunities from time to time where things don't perform in the same way. The most dramatic example in the last 12 months for international positions, the International Growth Fund lost 31%, which actually is better than the Large Cap Growth U.S. Domestic Fund, which lost 33%. And the Value Fund is down 11.66. So a pretty good spread, almost 20 points, 18 points, something like that. Nowhere near as big as the U.S. variance between large cap growth and value, but it's noticeable. And again, that may or may not be worthy of adjusting. The other segments, minus 15, minus 16, minus 21 for small cap, and minus 18 for emerging markets. Within a few points of each other. So when you look at just the money that's in international, I am now splitting that slightly differently as a target, as a goal, as a framework. International growth, 18%. International value, 22%. Pacific and European indexes at 10% each, and international small and emerging markets as 20% each. So it may change in a year. It may not change for 5 years. You may have one segment that overperforms another segment, and you can rebalance that once a year is probably going to be sufficient. But that's the new layout for the international funds. A very small change. The only change was in the growth versus value. I think we were doing 16 and 24% in growth and value, and now it's 18 and 22%. So kind of taking advantage of value not losing anywhere near as much as growth, and moving some of the things that have lost less in the short term into something that's lost more in the short term. A year. Short term is a year to 3 for me often. In the U.S. part, the U.S. equities. Oh, by the way, before I get to that, I still do generally use the Vanguard REIT fund, and give or take 5%. Historically, I had been doing 5 to 10 or even 10%. I've let that drift down just because the real estate market seemed kind of hot in the last couple of years, and that's worked out relatively well because the REIT fund is down 26% year to date, ending 12/31 of 22. So not having a lot of money in that portion in this occasion helped out. So I'm usually having that around 5%. You don't have to, if you have 8% or 10%, you don't have to sell half of it. You could, but it just depends on how tight you want to get to these. And often if you're within 1% or 2%, you're probably okay. It's not going to be a big deal, especially, again, if you're in a taxable account. United States domestic equities, stocks in the United States. I use 6 funds: large cap growth and value, mid cap growth and value, small cap growth and value. For many years, I've had growth and value be 50-50. So whatever amounts in growth is the approximate amount that's in value. Several years ago, I switched to 55-45, which gave the bias to value, which for a little bit of time resulted in a slight underperformance compared to the S&P 500, which is the large cap value, and the large cap growth, almost equal weightings, because there was less money in the growth and it was doing better. But I'm also trying to hedge against volatility, hedge against risk, because, well, you don't always necessarily make the most. If you can avoid some of the downside, sometimes you can work out okay. So it's a combination of making reasonably good returns and avoiding some potential problems, but in the long run, doing as well or better with risk that's equal to or maybe less. I mean, that's the dream. That's the goal. So hopefully from time to time we can achieve that. Well, if you had been following the Polaris Plan in 2022, oh, by the way, for all of 2022, because I changed this when we had the big market drop in 2020, when COVID started, I went to 60% value and 40% growth, which is a pretty big shift from the neutral 50-50. Well, in 2020, that worked great. 2021, growth and value did about the same, No advantage, no loss there. But in 2022, oh my God, the difference was amazing. We've talked about this before, so I won't belittle the point. But in case you haven't listened, large cap growth for 2022 was down 33%, and large cap value was down 2%. So you have a couple of things here at play. So the growth now, to me, doesn't feel materially overvalued compared to value. You could argue that I'm mistaken, but that's kind of where my feeling is at this point in time. And since neither one of those segments is particularly out of line with historical norms, or at least not in relationship to each other, I no longer feel the need to be 60-40, and I'm going back to 50-50. The other thing that is an interesting possibility, just something I think about, value was down 2% by the end of the year. And of course, now only a month or so, a month plus into 2023, the market's done very well. And that's cool. Maybe too much, but you never know. You never know. How will these things do going forward? I don't know. And when I don't know, that's part of the reason of going back to 50-50, large cap growth and large cap value. The other thing that is calling to me, tempting me, is that if large cap growth is down 33%, now let's just say it takes a while, maybe it takes a couple years. If it regains all of that and goes back to where it was on January 1st of 2022, any new money that you put in there will grow 50%. Now, I'm not saying an investment in the Vanguard Large Cap Growth Fund will make 50%. I'm saying if it returns to where it was, you would make 50%. So if you had $100,000 in large cap growth and you lost 33%, you're down to 66,000. If that goes back to 100,000, and that's a big if or when, of course, that's a 50% return. So it's a fascinating thing with percentages. So you lost 33%. If it goes back, you make 50%. Just like if you lose 50% in part of your portfolio, whenever, if you lose half of a position, if it goes back to where it was, you doubled your money. That was a little bit of luck that some of us got to enjoy in March of 2020 when small cap and value stocks fell 50%. New money that was put in March or April of 2020, 6 to 12 months later, doubled. Absolutely freaking amazing. Now, the money that you had put in before the big drop in March of 2020, you put in 100,000. It fell. It went back up at the end of the year. You still had 100,000 plus some growth because the 2020 was up. But the magical point was buying in that big drop. And you never know when those are. And all the research I've read or tried to do myself shows that setting aside a big bunch of cash or holding money in the cushion or in bonds, waiting for one of those big drops doesn't work because you might miss out 2 or 3 years of big gains. And then the big drop hits and you're like, now I can put in my cash and talk about spectacular returns I made in the short term. But you would have made more money if you just put the money in 3 years ago and wrote it out. So we don't want to do that. But if you can take money, as I'm doing in this case, taking some money from large cap value that's down 2%, if it fully recovers, you're going to make about 2%. Whereas if the large cap growth fully recovers from its 33% loss, you can make 50%. So I don't know. What's going to happen next year, the next 3 years? I don't know. So I got to the point where I was like, well, if I don't know, then I have no reason anymore to be anything different than 50-50 growth versus value. And this 50-50 applies for large cap, mid cap, and small cap. So that's different. The one thing that hasn't changed is I still have half of all the money in large cap and then the other half in mid cap and small cap. So if you look at these 6 funds only, the 6 U.S. stock funds, and let's say you have $1 million going into that portion of your portfolio. You've already figured out the cushion. You've already figured out your international and the weighting there and allocation there. So we're going to ignore all this stuff. But just $1 million in the U.S. portion, you would have 250,000, 25% in large cap growth, and the same amount in large cap value, 25%, 250,000. Those two would make up half of your domestic portfolio. And then the other half, the other 500,000, would be divided up in 4 equal parts in mid-cap growth, mid-cap value, small-cap growth, and small-cap value. So there it is. That's where I am. That's the change that I've made for the plan, those adjustments. Not particularly huge, but they could be pretty rewarding. I do know that for a lot of people, if you had all large cap growth last year, I've talked to people that have lost 35, 40, 45% because that was the part of the market that got crushed. Now, maybe it gets uncrushed this year. Maybe it doesn't. But if you had a 60% weighting in value and a 40% weighting in growth, you didn't lose the 26% that the total market was down 19.5. You might have lost 13 or 14%. Huge win. I'm very, very happy to have a net portion of the portfolio to beat the U.S. stock market by 3 to 5% in one calendar year. That may never happen again, ever, but it was nice. We also got very lucky in bonds. I've talked about that in other segments. International, the performance was about what you would expect, or about what everybody else got, or about what the total international fund did. If you have high expense ratio funds that are doing a lot of trading and your expenses are higher, you could do a lot worse than all of these numbers. So keep that in mind. You want to keep your costs low. You want to keep your taxes low. You want to keep transactions low. And where possible, use index funds. All right. So I think that made the point that gets everybody up to date, everyone who listens. If you have questions, whether you're a client or not, you can send me an email, phil@polarisfinancialplanning.com. If you like the sound of this, but you don't want to be bothered with doing it because you fucking hate doing it, you could hire someone who loves doing it. Well, although the last 2 to 3 months was a little stressful because I had to do it 150 times, but I do like doing this, and it's kind of fun to see possible ways just to eke out a little bit more money. It just popped in my head because I did mention it earlier. I got someone who had listened to the show and they have like $50,000 and they're like, well, how do I do all this stuff? And I said, you don't. Your biggest problem is that you have $50,000, because if you eke out 1 or 2% more performance on the 50,000, while that's nice and it may be worth your time to do so, you only can decide that. The really big thing that you can do to make your life better in the future is to save more money. So that's the driving factor when your portfolio is small. When your portfolio gets bigger, you have different concerns. Where should I be and when? And do I make these couple percent adjustments? Are they worth it? If that's something that doesn't interest you, but you're fascinated by it, you could, of course, potentially hire me. That's me, Phil Ferguson, and hire Polaris Financial Planning. You can send me an email, of course, phil@polarisfinancialplanning.com. And despite what it says on my website, which is tragically out of date, and I'm a very bad website person, my current minimum is $2 million of what they call AUM, assets under management. So anything from your employer, your current employer, does not count. Any money you have in land or buildings or a house does not count. If you have $1 million car, unless you're willing to have me sell it and buy investments, that doesn't count. So this is a pretty small percentage of the population that has $2 million or more. I understand, and I'm sorry. I really wish I could help everybody, but I'm feeling pretty full, but I'm also not completely stupid. So if someone has more than $2 million and wants to hire me, we can have that conversation. Again, the email is phil@polarisfinancialplanning.com. And for everybody else, while there was a slight delay in you getting my thoughts on this, here they are. I just laid it all out. Absolutely free to you. Hopefully it provides some benefit and advantage. And if it does, all I can ask is that you leave a 5-star review for the show. You could send me an email saying, hey, Phil, I love your show. Thanks. I always like those. I have had a couple where people have said really, really gushing, embarrassingly nice things that they've been listening for years, and they're now going to be able to retire And before, they weren't going to be able to retire because the investment advisor or the person selling them product was, I don't know, ripping off is too strong because it's all legal. But when the market's making 10%, if you're making 1 or 2%, you're going to have a really hard fucking time getting a big enough portfolio to retire. Anyway, going to wrap this up. We'll go do something else. If you have questions, concerns, comments, email me. I've said it too many times already. Email me and we'll take a break and get on with the rest of the show. Once again, thank you for listening to the show. Of course, this is the end. We're wrapping it up. In a couple of weeks, I will be at the Free Flow Conference in Orlando, Florida. Just Google that, Free Flow, all is one word, 2023, if that helps reduce your search a little bit. And then a few weeks, I think after that, I've got to go make my reservation. My plan, of course, is to go to the American Atheist Conference in Phoenix. Oh my God, I'm going to have to check that, but I'm pretty sure it's Phoenix. So I do hope to see you out there in the world sometime soon. Until then, ciao.
Sexual advances are not appealing. In fact, I'm starting to get the uh-oh feeling. And my mama said my special parts are just for me. So why in the world are you trying to creep?
Stop! Don't touch me there. This is my no-no square. Stop! Don't touch me there. This is my no-no square.
To try and touch my square takes a lot of nerve. Who do you think you are, you freaky deaky perv? There's a dude with some candy in a shady old van. I think he wants to mess with my purity plan.
Stop! Don't touch me there. This is my no-no square. Stop! Don't touch me there. This is my no-no square.
My square's not a circle or a period or dot. It's just my one little very old spot. So keep your grubby little dirty little hands off me while I want you to respect my privacy. I just want to be left all alone, so step off me and go back home. I'll tell you again if you're not aware that this is my own no-no square.
Stop! Don't touch me there. This is my no-no square. Stop! Don't touch me there.